So this is Chapter 11, Part 2. We were just looking at what happens when the market rate of interest is different than the contract rate. And the example we just went through showed a situation where the contract rate is 5%, but the market rate is 10%. And what we can see is that to make our bond attractive relative to other bonds in the market, we would have to lower the price of our bond. We would no longer be able to issue the bond at the face amount of $1,000. If we lowered the bond in this simple example to $500, then the investor would be able to earn the 10%. So instead of being able to borrow $1,000 and pay $50 of interest, that would be 5%, we would only be able to borrow $500, but we'd still be paying the $50 of interest, and that would give an effective interest amount of 10% to the investor, which is what the investor desires from the marketplace. If we remained firm at the $1,000, of course no one would buy our bonds. We would not be able to raise any money. And that's the way the bond market works. So just to summarize, if our contract rate, and that's an abbreviation for contract, CAK, contract rate is less than the market rate. And remember, the contract rate is our bonds. So in this particular case, just like the example up above, if the contract rate is less than the market rate, our bonds are less attractive. And therefore, our bonds are going to sell at a discount. We're going to have to reduce the price of our bonds below the face amount of our bonds in order to issue those bonds, so that the effective rate of interest is raised up to the market rate. If our contract rate, on the other hand, let's say the opposite was true. Let's say the contract rate was 15% and the market rate was only 10%. Then our bonds, this is the market rate, so contract rate is greater than the market rate, then our bonds are going to sell at a premium. They're going to sell for more than the face amount. So in this particular case, maybe they sell for $1,200 instead of $1,000. If in fact our contract rate was higher than the market rate, so we're going to receive more from the issuance of those bonds to reflect the fact that our bonds are paying a higher rate of interest. So let's go through a couple examples. We can kind of see what happens. So we're going to take a look at a couple transactions affecting bonds payable. So first of all, we're going to assume that we issue $1 million worth of bonds, 5-year bonds, 6%, and we're going to issue them at 98. So let's just take a look at these terms. So first of all, we're issuing $1 million. This would be the face amount of the bonds, the amount that's going to be due at maturity. 5 years, that's the duration of the bonds, the amount of time the bonds will be outstanding. 6%, this is the contract rate. And we're issuing them at 98, which basically, the way bonds are priced, that means they're at 98% of the face value. So 98% means that it's less than the face amount, and so they're basically being issued at a discount, which means that the market rate of interest must be higher than the contract rate. So the market rate of interest must be higher than the 6% rate for these bonds to be offered at a discount. And we see that up above where we have basically our rule. And so where the contract rate is less than the market rate, the bonds will be issued at a discount. And by the way, this holds true for existing bonds too. So if you hold an existing bond and the rate of interest in the marketplace goes up, the value of your bond will go down. So the bond value and interest rates move in opposite directions. So again, if the market rate of interest were to go up, then the value of the bond would go down. Okay, so very important relationship. So people that hold bonds as an investment, maybe you paid, let's say, for this bond, you paid, in this particular example, let's say you paid 98%, so you paid $980 for every bond. If the interest rate tomorrow goes up, that bond would be worth less than the $980 you paid for it. So if you were to sell that, you would be selling that bond at a loss. So if interest rates go up, the value of your bonds goes down. If interest rates decrease, the value of your bond goes up. Because again, if interest rates decrease, your bond is more attractive in the market. And therefore, it will sell at a higher rate, a higher value rather. Okay, so let's take a look at this. So first of all, the issuance of the bond. So we're going to issue the bond. So we're going to debit cash. And again, we're going to take $1 million times 0.98. So we're going to get $980,000. We're going to credit bonds payable. And bonds payable is always going to be at the face amount. So we could almost put that in parentheses all the time. Every time we have a credit to bonds payable, it's the face amount. That's the amount we're going to repay at maturity. Now the difference here, we can see, obviously we issued these at a discount. So we're going to have a $20,000 debit here, and that's going to be to a new account. It's a contra liability account, and it's going to be called discount on bonds payable. $20,000. And over on the side, you can see I've set up our balance sheet over here. The liability section, we'd have bonds payable. So we'd initially record this as $1 million. We'd have the discount on bonds payable of $20,000. And so we'd have our bonds payable net amount of $980,000. And we can go ahead and put that debit in here of $20,000 for the discount. And let's just say that this issuance was on 1/1. Okay? All right, then we're going to have interest payable semi-annually. So let's say June 30, we're going to have interest. So we're going to debit interest expense and credit cash for right now. Cash is always going to be at the contract rate. In other words, that is what is specified to be paid to the bondholders, and it will never change. So the cash amount here is going to be $1 million, the face amount, times 6%. And since it's for a half year, times 1/2, because it's payable semi-annually. So this is for the 6-month period, so it's times 1/2. So that's going to be $30,000. Now what we need to do is we need to eventually reduce this discount down to 0. So what we're going to do is we're going to amortize this discount down to 0. We're going to amortize it just on a straight line basis over the number of interest payment periods. Now here we have 5 years, and we're paying interest twice a year, so there's going to be 10 periods. Okay, so we're going to be making 10 interest expense entries. So we're going to want to amortize 1/10 of this each period, and if we divided that by 10, we'd have $2,000. So this is on 1/1. So on 6/30, we're going to make an entry for $2,000. So 1/10 of that is going to be amortized. So we're going to credit discount on bonds payable, 2,000, and therefore interest expense is going to be $32,000. Okay, and so what we're going to do is basically do that. We're going to make 10 of these entries. Every 6 months, we're going to make an entry. So there's going to be 10 of these entries that are going to be made. So let's say we make another one, 12/31, debit interest expense, 32,000, credit discount on bonds payable, another 2,000, and cash, again, it would be the same calculation, would be another 30,000. So right now, at this point in time, if we just did a balance at the end of the year, we'd have a balance in our discount account of 16,000. So if we did a 12/31 balance sheet, we'd have 16,000 here. We'd have $1 million here. And we'd have 984. Sorry for the writing. 984,000 as our balance. So that's how it would look on our balance sheet. So let's just take a quick look at this and see what this is telling us. So if we look at our interest expense, we'll notice that our interest expense is actually higher than the cash interest paid. The cash interest paid represents the 6%. And as we saw up above, our bonds are ended up being issued at a discount, meaning that the contract rate was less than the market rate. So what the interest expense is showing is, in fact, the interest expense is more indicative of the market rate of interest, which in fact is higher. The market rate of interest was higher, and that's why our bonds sold at a discount. And in fact, our interest expense does show up as being higher than the cash interest, which is reflective of the contract. So the contract rate of interest is the 30,000, but the interest expense is more reflective of the market rate of interest. And that's how we want our financial statements to reflect interest. We want it to reflect the true cost of borrowing, which really is at the market rate. So it does make sense. And that's accomplished by amortizing this discount. So one more entry. Of course, we could make the 10 interest entries, and then at the maturity date in 5 years, we would simply debit bonds payable for $1 million and credit cash for $1 million to pay them off. But let's assume in this case that the very next day, after these first 2 entries for interest, on 1/1 of the next year, we were to go ahead and the company could redeem these bonds at 103. Okay, so let's just make that entry. So we debit bonds payable for $1 million. Again, that's the maturity or face amount. We would credit cash for 103% of that, or $1,030,000. The balance in our discount account is $16,000. We would have to credit the discount for $16,000 to bring that account to 0, and then we would have a loss as a result of this of $46,000.